Hello and welcome to our last discussion on capital leases. Please make sure you have watched the first 3 videos before viewing this video. This video will cover 3 other types of capital leases. It is important that you view this before class so that we can learn more together in class. After viewing this video, you will be able to account for a lease with an unguaranteed residual value, account for a lease with a bargain purchase option, and account for a lease with a sale leaseback. We discussed how to account for a lease with a guaranteed residual value in the last video. In this video, we'll discuss accounting for unguaranteed residual values and bargain purchase options. Our unguaranteed residual value means that the lessee has no obligation for the fair market value of the asset at the end of the lease. The lessee is obligated only to return the asset to the lessor. A bargain purchase option allows the lessee to purchase the asset sometime during the term of the lease at a price that the lessee would not turn down. It is assumed that the lessee will purchase the asset at the bargain purchase price. Let's look at an example of a lease with an unguaranteed residual value of $2,000. This means that the lessor expects the asset to be worth $2,000 at the end of the lease. However, the lessee does not guarantee it and is not responsible if the asset is not worth $2,000. The value of the asset at the end of the lease is the lessor's responsibility. There is no difference in the way the payment is computed. The lessor's cost is the full $40,000 because they are responsible for the residual value. The lessee's cost is the amount the payment covers that does not include the residual value. The lessee is not responsible for the residual value, and therefore all accounting for the lessee is after the residual value. The lease payment does not include the residual value because the lessee is not responsible for the unguaranteed residual value. The lessor and the lessee have 2 different costs. The lessee and the lessor will not use the same amortization table. 2 different amortization schedules are required. The lessor uses the same table used for the guaranteed residual value. The table will start with the cost at the full cost of $40,000 and ends with the residual value of $2,000. The lessee uses a different table that starts with the amount that the payments cover and ends with 0. The lessee's amortization schedule is different, so we will look at this one. The cost to the lessee is not the total cost of the asset. The cost to the lessee is the cost less the present value of the unguaranteed residual value. The lessee's cost is the amount they are going to pay for. After making the final payment, the lessee owes nothing. The amortization schedule ends with a liability of 0 for the lessee. The only difference in the journal entries is what happens at the end of the lease. At the end of the lease, the lessee returns the asset to the lessor. The lessor records a reduction to the lease receivable for the residual value. The asset is recorded for the lowest of either the residual value or the fair market value. The amount cannot be higher than the residual value because a gain cannot be recorded when receiving the asset. A gain can only be recorded when the asset is sold at a later date. If the fair market value is lower than the residual value, the lessor records a loss. The lessee is not required to make up the difference. The lessee records the return of the asset. The asset is removed at the original cost, and the total accumulated depreciation is also removed. Total accumulated depreciation will be equal to the cost. A bargain purchase option allows the lessee to purchase the asset at a specific date during the term of the lease at a price that the lessee would not turn down. It is assumed that the lessee will purchase the asset at the bargain purchase price. As such, the lease term is assumed to end on the date of the purchase option. Using our example of leasing an asset with a cost of $40,000 for 4 years at 8%, let's add a bargain purchase option for a payment of $6,000 at the end of year 2. The lease is accounted for as a 2-year lease, and the present value of the bargain purchase option is subtracted when computing the payment. The payment is higher because the total cost of the asset will be paid for in 2 years. One amortization table is used for both the lessor and the lessee. The table begins with the cost of the asset and ends with the bargain purchase option. The $6,000 bargain purchase option will be paid at the end of the 2-year lease. At the end of the lease, the lessor receives the bargain purchase option payment from the lessee and removes the last amount of the lease receivable. The lessor already removed the cost of the asset at the beginning of the lease and does not remove it again at the end of the lease. The lessee pays the bargain purchase amount and purchases the asset. The last lease liability is paid with the bargain purchase option payment. The leased asset now becomes a regular asset owned by the company. The lessee continues to depreciate the asset through the end of the life of the asset. Depreciation for a bargain purchase option lease is computed using the life of the asset because the lessee is expected to keep using the asset until the end of the life of the asset. Let's switch gears and talk about a sale-leaseback. A sale-leaseback is used when the lessee has an asset they need to keep using, but they also need cash. Regular bank financing is not available, so they sell the asset to someone they can lease it right back from and keep using it. This is most common with buildings. The lessee records the sale of an asset, which is a debit to cash received, remove the asset and accumulated depreciation. The entry will not balance, and typically a gain or loss is recorded. In this case, the gain cannot be recorded all at once for the full amount because the lessee is still using the asset and in substance really didn't sell it. A gain is recorded as a liability account called deferred gain, and it is amortized into gain on sale or a reduction to depreciation expense, a little each year over the life of the lease. The lessor records the purchase of the asset at their cost, the fair market value at the time, and records the transfer back to the lessee via the lease. A sale-leaseback is just as it sounds. The lessee sells the asset and leases it right back from the buyer. The only difference in accounting for a lease that is a sale-leaseback is the purchase and the sale recorded first and the gain on sale deferred. The deferred gain is amortized over the life of the lease. The terms of the lease can be any that we have discussed so far, guaranteed or unguaranteed or even a bargain purchase option, at a given rate and term of the lease. The accounting for the lease is determined by the features specified in the lease agreement. After viewing this video, you should be able to account for a guaranteed residual value lease, or account for a bargain purchase option lease, and also account for a sale leaseback. Please make sure that you fill out the fill-in-the-blank pages in your course pack and work through the self-test, practice as you learn, and easy test on StudyMyAccounting.com before coming to class. Thank you for taking the time to be prepared for class. It is very much appreciated.